Hello and welcome to the Providence Investment Update for July 2022. My name is Michael Ogg and I'm joined today with Grant Patterson, CIO and founder of Providence. Welcome, Grant.
Thanks, Mike.
And Will Porter, Head of Investment Strategy at Providence. Welcome, gentlemen.
Thanks, Mike.
Grant, I thought I'd start with you, as always, and the title of your global outlook and strategy. The last 3 quarters have been seismic shifts. The tide has turned, disruptive times. So there's definitely a change theme evolving there. This one is now unconditional commitment. Can you please explain what you mean by that?
Yeah, sure, Mike. That was a term used by Jerome Powell just recently at the G7 meeting in Europe, and it was quite a strong statement. And he was talking about his unconditional commitment to fight inflation. And if you have a look at unconditional, that's an absolute, no barriers, no limits. And so he's given a very clear indication that he will do whatever it takes to tame inflation, even if that may break the economy. And so the jury's still out on that in regards to how difficult it's going to be during this time. And so that unconditional commitment, aggressive increasing in interest rates, is likely to have some, impact one way or the other. And I guess in a sense, it's a policy of least regret. I've got to fight inflation and it may cost the economy while I'm doing that. And so that was something that was very front of mind just recently.
So Grant, what does that mean for the famed Fed put, which seems to be around for a long time? Does that change that? Well,
I think it does, really, Mike. I mean, we're undergoing a macro regime change, if you like. I mean, we've had, a couple of decades of declining interest rates, of benign inflation, above trend GDP growth, and a government and a Fed, central banks, that have been pumping the economy full of money. And any time there was any weakness in markets, then the Fed would start cutting interest rates. Well, they can't do that now because inflation is an issue. So therefore, markets are vulnerable, I think, to a correction, which we've started to see. And the Fed really unable to do anything about that. So I think the Fed put has been put on hold for some time.
Thank you. Will, a question for you. I mean, given this weakness in markets, given this weakness in asset prices, how have portfolios performed during this time?
So Mike, as you pointed out, we've been sort of talking this narrative for a long time that things were going to get a little bit more difficult. So fortunately, we were very well diversified leading into the weakness that we've seen more recently. So our portfolios have held up reasonably well, and I think we're pretty proud of the results we're going to provide our clients. We're not out of the woods yet, and we're now looking for really strong opportunities to add to portfolios to give those returns that clients are looking for.
So Will, what does that all mean for asset classes?
Yes, I'll start with bonds because bonds sort of form the foundation for valuing every other asset class. And we've seen some real volatility there, probably the worst drawdown we've seen in a long time in capital value. We think around here looks about fair value. There's a lot of long-term inflation built into prices and rate rises from central banks around the world built into the current yields that you're getting on bonds. And at the high yield that we're getting now, I actually think they might offer a little bit more diversification for benefit for portfolios going forward as well. So it's looking reasonably attractive, and we added a little bit over the last quarter in that space. Values have come down a long way. So we were looking at international equity markets being very stretched in their valuations coming into the end of last year. We've seen a very rapid reduction in share prices in certain markets, and valuations look more reasonable. But to Grant's point, the economic outlook is still a little bit hazy, and there is this risk of some sort of policy mistake by the central banks. So we're not aggressively buying into any of the weakness at this point. We think there'll be more opportunities as we see some of those earnings come down, as well as those valuations looking more attractive. So that's in international markets. Australia is actually now trading one standard deviation below its long-term average valuation. But again, that's probably obscured a little bit by the really strong commodity prices that we've seen. So we're not in a real rush to be deploying capital into risk at this stage, but we're poised and waiting for that great opportunity that's around the corner, I'm sure. With credit, much like equities, we've seen some sort of drawdown and a spread widening, but we don't think it's significant enough for us to be really excited about that space, especially in high yield. We'll probably wait a little bit longer and be patient. We've got the ability to do that at the moment. In alternatives, they've done the job that we were hoping they would do. The diversifying alternatives have really given us that diversification benefit and protected portfolios in the drawdowns that we've seen in equity markets. And our growth alternatives have really given us an alternative source of return and has performed really strongly for us. So we're really happy with the allocations we've made in alternatives.
And the direct property will has performed pretty well for us. I mean, we've been in the boutique sort of area, so specialist disability housing, regional hospitality, you know, pretty resilient to a downturn in the economies, providing very solid income. So we've been pretty happy with that. And also the suburban retail shopping centres that are anchored by, you know, the large food supermarkets, they've performed very well, providing good income, and the managers have been very proactive in helping their tenants during the very difficult times, repositioning the assets, and they're now pretty much fully occupied. So that's been a good space for us.
Will, can I just press you on one sector, which is the banks? The banks, obviously a large part of our index. A lot of clients are in the banks. What's the current view in the banks?
Yeah, so the banks it's a complex situation for the banks. The net interest margins have definitely improved for them. So that's the amount of spread they make between their deposits and what they lend money to. So as rates have gone up, that's become a little bit more of an attractive environment for them on the revenue side. But given the pace of this rate rise that we've seen from central banks, the real risk is what it does to bad and doubtful debts for the banks. And that's the big unknown and the big concern for us. So again, it's not something that we're really actively going out to deploy capital into, but it's certainly a space that we're mindful that an opportunity will probably present itself as these valuations come off.
Yeah, I think, you know, like there's a lot of press at the moment, Mike, in regards to house prices, and it's always an emotive period of time. And as the interest rates are going up, in a sense, seems to be we're talking ourselves into a housing pullback. Now, it's not surprising that housing would have a breather, given the strength of the market over the last 2 or 3 or 4 years, which has been phenomenal. So it really comes down with the banks about how difficult that housing sector is going to be. And sure, there may be some weakness. I think we just need to be careful. I mean, there is likely to be a shortage of housing in a couple of years' time as building approvals have been put on hold. The cost of building houses is going up. So, you know, I wouldn't get too negative about the sort of 2 or 3 or 4 year outlook on housing, but in the short term, it's going to play on investors' minds.
Grant, there's a lot of noise around at the moment on the news with wars, currencies, you know, etc. How are you seeing things from a global macro perspective?
Well, it's quite complex, Mike. There's a lot of moving parts at the moment. I mean, you know, we've clearly got a higher inflation rate and higher interest rates coming through. That's going to put some pressure on growth. So you've got higher inflation, lower growth, and that could end up being a stagflationary environment that we would be very concerned about. We still don't know yet. So that's one of the issues. Globally, we have an energy crisis, particularly in Europe, which is unlikely to go away in the short term. And so that's putting a lot of pressure on energy costs, and you've got higher food costs coming through. So, you know, the household sector around the globe is faced with higher energy costs, higher inflation, higher food costs, and higher interest costs. And so that's going to put a bit of pressure on household income and probably spending. So, you know, I think sort of a slowdown around the globe is likely. I think there's a real chance of a mild recession, which the markets have probably priced in at this stage, by the way, but, you know, it's still quite uncertain. So, you know, I think it'll be a tough economic environment while Fed are being as aggressive as what they are in increasing interest rates.
And so, Grant, just going back to sort of the more portfolio side and the bigger picture side, how are you managing portfolios in this kind of volatile environment?
Well, I think the most important thing is to try and take out the emotion You know, we've had a lot of volatility since the beginning of the year. I mean, the US market is in a bear market, and there's a lot of volatility going on and there's a lot of noise. So the real key is to focus on valuations. We've got to understand that in bear markets, markets can rally very strongly and not all the stocks bottom at the same time. So it's a matter of trying to get the noise out of the way, focus on valuation, take the opportunities when they present themselves, look at the technicals to help try and find levels on certain asset classes, and you know, just be patient and waiting for those opportunities. The one thing that I think is really important is you need to be greedy at this part of the cycle. You know, we've started to see some weakness. And we've seen what's happened in a lot of the, you know, the cryptos and all of that sort of area. But in real assets, you know, we've seen a weakness. There's been free money. That's now no longer the case. And so I think while people are fearful, you know, that's when you want to be a bit greedy. And so that means demanding a higher level of return or a higher IRR from the assets that you're buying, because the discount rate's gone up, interest rates have gone up. So we don't want the same return as last year. We want a better return from any assets that come to us from fund managers or from different products.
So Grant, does that mean that you're fully invested now, or you're still keeping some dry powder for later down the track?
We've certainly got a lot of liquidity in the portfolio, whether that be through government bonds or cash. I mean, the real key for us is still remaining very diversified to try and cover all the different moving parts in this very complex and uncertain environment. And being diversified and disciplined in that will protect and preserve capital. And then we've got to wait for the opportunities which will arrive. We've been here before. In our last 22 years, there's been cycles like this, and you need to be patient. There will be some great opportunities, so you can't be frightened to invest, but you just need to be patient and poised, as Will said.
Thank you, Grant. And is there any update on Providence?
Sure, Mike. Will and Mel and the team are still working through with our clients, moving all the clients on the custodian platform, which is going to be very beneficial in regards to transactions and the ability to execute. So that's still going ahead. We've also had recently our client luncheon, both in Sydney and Melbourne. It was lovely to get together again face to face after so much time apart. So that went very well for us. The website, the Providence website, has been refreshed. So if any of our clients wish to pass the link on to any people that might be interested, the website's just been refreshed. And also in Melbourne, we're pleased that the new office in Melbourne in 101 Collins Street is nearly complete. Very excited, Jimmy's very excited to have the new offices in Melbourne, and we all look forward to being down there, utilising those offices when they're complete over the next couple of weeks.
Well, Grant, thank you very much for your time. Will, thank you for your time. And thank you for watching. I hope you enjoyed the discussion, and we look forward to seeing you again soon. Thank you.